Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carrillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carrillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carrillo. Today we have Adrian Washington. Adrian has over 30 years of experience in urban real estate development, construction, and management. Since founding NDC in 1999, he has led the development of over 1 million square feet of real estate with an active pipeline of another million more. So thank you so much for being on the show, Adrian.
Thanks, Charles. Great to be here.
So can you tell us a little bit about yourself, both personally and professionally, before getting involved in real estate investing?
Well, sure. I grew up in Washington, D.C. I mean, actually, I was born in France, but only spent 3 months there. So I can't really count myself as a French expat. But so I grew up in Washington, D.C., went to school out in California at Stanford University, and worked out there 3 years in corporate America. Left that, went back east to get my MBA from the Harvard Business School, and was up in Boston for 2 years. Great time up there. Came back to DC as a management consultant, working, at high value strategic planning, consulting for Fortune 50 companies, and did that for about 3 years. And so I was really only at age 30 before I launched my real estate career.
Oh, wow. And why did you choose real estate as your investment vehicle?
Well, it's a classic thing for an entrepreneur is that I did it as a hobby and liked it a lot better than the job I was doing, and had the entrepreneurial bug and thought I could be successful in it. And so when looking around, I wanted to, leave a bigger firm. I wanted to start my own thing. And I was investing and renovating real estate on the side and said, this is what I love. And so I decided to make it a business. And that was 30 years ago.
So what were your first real estate investments? What were you starting with? What type of properties?
Well, I guess the typical, really the first one was actually my own home. When I moved back to DC, I purchased a home in a, run down but up and coming neighborhood, and started to really renovate that. And I had, hired some contractors. They didn't work out. I ended up, literally doing a lot of the work myself. I mean, literally, Charles, I was, doing carpentry and sanding floors and plumbing, and I loved it. And I would do this after like a 12-hour day as a management consultant. I was a lot younger, had a lot more energy then. So, I loved it. So it was my own home. And what I saw was, two things that have continued to drive me. One was the great returns. I mean, we bought a property for X, we put in, Y amount of capital on top of that into renovation, and voila, the value was much higher than, X plus Y. So I saw the value in that. And then from a, just a personal satisfaction the point of view, I like the beauty of transformation. I liked using my ingenuity, my creativity, my capital market skills, everything to take something that was, not really usable, turn into something that was beautiful and usable and could benefit myself, could benefit the communities around me. And I just loved that transformation. It made me feel like I was really producing something. And so the ability to drive excellent returns and ability to create were two things that just captivated me.
Wow, interesting. What is your firm's current investment strategy right now with what you guys are developing, what you guys are keeping, what you guys are selling?
Okay, so we're balanced in that regard. 80% of our development is in residential, about 20% is commercial. Within that product mix, we do a number of things. We do very mission-driven projects. We do affordable housing that, works for lower moderate income people, and we do very high-end housing. So, I mean, in the same year, we could be doing a project where we're, the condos in itself are over $1 million, and we could do another project where the condos are selling for $100,000. And, the $1 million ones are, nicer than the $100,000 ones, but they're not like night and day. The $100,000 ones are still high quality, great places for people to live. It's just that you finance them differently. But, Charles, go back to your question. I'd say, about 80% of the stuff we do, we end up exiting either, say in the case of a condo, you're selling them to the public, obviously they're buying units, or in the case of a rental building, you will exit that through either refinancing to, exit your investors or to a sell to a third party. So I'd say about, 70, 80% of stuff we exit upon development, and about 20 to 30% we keep for a long-term hold.
So with everything with affordable housing, because you said like it's not night and day between these really nice properties and the ones that you're building for 100,000. How is the financing differ between it? Because I see with like where we are after COVID or at this part of COVID, the increase in construction costs, you have labor shortages. I mean, it's very expensive to build. And how are you making that profitable for you and your investors with affordable housing? Even though, I mean, it's fantastic for your community. I'm aware of that, but just for you.
Yeah, no, I mean, it's interesting. I mean, one of, my sort of thoughts when COVID first happened was that construction prices would go down. I thought there'd be
Mhm.
less demand, that subcontractors would be hungry for work, and that didn't happen at all. I think there was a little bit of lull in the beginning when people started to figure it out, but since then, prices have continued to increase. And also, as you probably know, particularly in the raw materials cost, wood and steel have gone up tremendously, especially recently because of supply chain challenges. And so that's been a challenge as well. So going back to affordable housing, the way you make it work is essentially with the government's money. There are numerous programs, both through the tax code in terms of tax credits. We can talk about that. There are, low interest, subsidized debt on it. There is what's called gap financing that can come from a local government, from the federal government. And essentially what is done in the situation is that, the governments want this as an important need, but they realize the developers are still taking risk and making effort. And so they allow us to either earn a profit, charge fees, et cetera. And what our investors do is they share in that. So they may provide, initial seed capital to get the project running. And then when the government financing comes in, that's taken out, there's a profit allowed on that. Or there could be, large development fees the developer earns. And to the extent that our investors invest in that, we'll give them a share of that portion.
Oh, it's very interesting. And are those tax credits, you said a lot of local, is there a lot of federal programs like that as well? Or is it
Well,
mostly?
there's a federal tax code program. One of them is the biggest one, probably is the low income housing tax credit,
Mhm.
or LIHTC is the acronym. That is typically syndicated through large money center banks. But there are also, a lot of programs where these tax credits can be earned by, individual, high net worth investors. So for instance, the Opportunity Zone program, we've used that to finance some of our projects. And those are projects where we've been able to create, friends and family types of syndicates where, you might invest 50,000, 100,000 one of our projects. We're able to pass on those Opportunity Zone tax credits to you. And, there's a lot going on in that program, but they provide very nice returns. And in addition to tax breaks, we're able to provide a market rate return on your investment. So you get the double benefit of tax breaks and market rate returns.
I've seen the LIHTC properties be advertised from brokers before, and I had some partners before that would say they kind of like veered away from them. How does that differ if you're selling a property like that, the new owner that's buying that property? How does that, how does what they can and can't do change after in buying a property with that?
Mhm. Well, it depends on the program. What we've seen a lot of times is that the original developer, like ours, and maybe some partners we have, will stay in a property through what's called a compliance period. The typical
Mhm.
compliance period, every program is different, but for LIHTC, typically there's a 15-year compliance period through which you need to keep the properties affordable. After that, it starts to burn off. In some cases, it burns off right away. In other cases, it burns off over time. And at that point, these properties can be converted to market rate. Or they can be re-syndicated. Let's say the property needs a refresh and you can go back into the tax credit program, use tax credits to do that and earn additional fees on that. So typically what we see is developers like ourselves will develop the property, bring it online, stabilize it, hold it through the bulk of that compliance period, and then do some type of exit, either an internal exit where we might shift it from, one entity we own to another, bringing in new investors as long as they cash out, or actually selling it to a third party who can then reap the benefits of that end of the compliance period.
It's very interesting. So you're having different investors that are interested in investing or financing, I guess you would say, investing in different stages of the project, whether it's the construction or whether it's the longer term when it's more of a stabilized asset. So that's great.
Exactly.
So how has COVID impacted your business? We talked about, labor, we talked about raw materials. Has demand changed where you are? What else have you seen over the last 20 or 12 months, let's say?
Yeah. Yeah, I mean, it depends on different sectors. I mean, we're not really in the office sector. That I think that sector has been impacted tremendously, both by reduced demand for office space, as well as vacancies, companies not being able to pay the bills. And it hasn't really shown up so much currently. I think it will show up in a few years down the road when these leases start to roll over and tenants either vacate or really push for consensus. So I mean, luckily for us, we're not really exposed there. We have some exposure in retail. I think that's also been challenged. I think it depends though on the type. I think sort of what's called neighborhood services retail, it still continues to do strong. So you've got your grocers, your convenience stores, those have continued to do well. Other types, like say for instance clothing, I mean, we're sitting here in our casual clothes, in our homes, and so no one's like going out and buying a new suit. So clothing like that has been affected, but actually it's part of a longer term trend where e-commerce is continuing to do that. So again, it's not a big part of our business, but we do have some assets there, and so we've had to face restructure those and find ways to make those work. I think in a big part of though what we do, we've been very fortunate to be well positioned. So on our affordable housing portfolio, demand there has continued to be strong, even though our residents were affected by COVID in different ways, and some of them were exposed to job losses. Because these properties are so desirable, because they are high quality properties that someone at a lower moderate income can afford, they really want to hold on to that. I mean, our waiting list for these properties are years long. And so when someone is fortunate enough to get into one of them, they want to stay there. I mean, we have very low turnover. We have, several buildings where tenants moved in on day one and they're still there, 10, 15 years later. So those tenants were very motivated to stay in, very motivated to stay current on their on their rent payments. The various stimulus check payments programs really helped in that regard. So our affordable portfolio, did really well. I think another area where we are doing well and are going to do well are in our condominium for sale. What we have found that there has been a tremendous demand. One of the, sort of post-COVID investment thesis we see is that people be much more interested in their home environment. They're not going to work from home 5 days a week, but they are much more inclined now. Hey, I'm going to work from home on Friday, or I'm going to work from home on Monday, make it a 3-day weekend, not do that commute. And so and also because they're not spending on things like commuting, they're not going to the movies as much, they have more disposable income. So we see demand for our for sale product even stronger than before. Condo sales have certainly in our market areas have increased both in terms of volume and pricing. So again, I think that's we're well positioned to take advantage of the COVID and post-COVID environment.
Yeah, I definitely agree with what you're saying about office. I don't know if people are going to get rid of their offices altogether, but I feel that when that renewal comes up, they might not be taking 30,000 square feet. They might take 10,000 square feet.
Absolutely.
And they might have people come in on Mondays and Thursdays and someone else on Monday and Wednesdays or whatever it might be. And I feel that's kind of the new normal. But speaking about that, where we are in mid 2021, what do you see for the next 12 to 24 months in residential and commercial real estate as I guess we're getting back to more normal little by little with the vaccines and everything else?
Well, no, I mean, again, our investment thesis is that people will value their home environment more because they're going to be spending more time there. They're going to want more privacy. So I think that, for sale, whether it's a single family home, a townhome, or condominium will become more valuable. People have more disposable income. They're going to spend more time. So it certainly says that type of product, residential, particularly for sale residential, will do really well. Interest rates, even though they've ticked up a bit, a few basis points over the last 2 months or so. They're still, compared to historical norms, really low. And, I think that the Fed will, will watch out and continue to monitor the situation. But I think they've made a firm statement that they are committed to a low interest rate environment for the next several years. I think that will be a boost to home sales. And as we rotate out of other classes like office, there may be opportunities for office conversion. So I think there's been a lot of interest, lately, especially for older, inefficient office buildings, say your Class B and your Class C properties, that as construction costs continue to rise, that we're looking at buildings like these are opportunities for conversion from office to residential. The structure's in place, the utility infrastructure is in place, and the value of the office building has gone down. And so from a economic perspective, the replacement cost is much lower there. And so I think you'll start to see some of these, particularly as you pointed out, Charles, that these leases start to roll and people are taking less and less space. And so building owner might say, hey, if I'm going to be only 60% occupied, I might as well just go ahead and let people go and be zero occupied and sell this asset to a residential developer.
Interesting. Is there anything with, we've seen, the interest rates going down. We've seen so much money printing in the last 12 months. Are you worried about anything in the economy that might have an effect as well on real estate or anywhere parts of the economy? I mean, is there anything that you're watching that you think might come back?
Well, I mean, I'm not an economist, and you can see there's sort of no crystal ball here. So, I mean, your guess is as good as mine. But I mean, my prediction and what we are structuring our activities around is a continued relatively low interest rate environment. Maybe a bit of surge of inflation in 2021, 2Q, 3Q, as all of that pent up, capital comes back into play as people get vaccinated, get back out there, start going to restaurants again. So maybe a bit of inflation there. I think we've seen some in fuel cost, in certain commodities, as more driven by, I think, supply chain difficulties than necessarily increased demand, but that will moderate over time. I mean, I think that we are in a secular low inflation environment. I mean, that's sort of a whole different subject, but our belief is, has to do with, kind of the demographic changes going on, lower workforce, things like that. And so, we don't see any surges in inflation. And so I think it's really about, and then I guess another niche we talk about is kind of, a lot of people talking real estate is urban, suburban kind of mix and how that will change. I think that the post-COVID environment will be, slightly advantageous for suburban versus urban. I think that, I think there was a big shift as, two things. One, from a health perspective is, people began, concerned about living in closer quarters, and particularly people who had relied on public transportation. I think that, that will be kind of slow to recover. And so I think that, both suburban kind of satellite office spaces, as well as people saying, hey, I don't need to be as close into the city because I'm only going to commute in 2 or 3 times a week as opposed to, 5 or 6 times a week. So I think there will be a slight advantage, but not necessarily to sort of the far out suburbs. I think that some of maybe the first ring suburbs that are away from downtown, but not so far away that you can't get in when you need to, I think there's a lot of opportunity there. And so we see a lot of opportunity for conversion of places there. I think one particular thing we sort of see is sort of taking one disadvantage and one advantage is that a lot of with the retail compression, there are a lot of kind of aging, smaller shopping centers that are no longer, economically viable, but great places to do mixed use, maybe, low scale townhouse communities with like some convenient shopping. We see a lot of conversion opportunities there in the close-in suburbs. So that's something that we're taking a look at.
It's amazing. I mean, there's a lot of this that was accelerated with COVID, but there's been so many changes that have kind of started from this just a year ago. So what do you think are the main factors that have contributed to your success?
I think that, luck, first of all. I always like to be humble and to give credit. I think we've been in some good situations at the right time. But besides that, I think development is, it's a great industry in that there's so many different ways to do things. And I think it's about picking a strategy, picking a niche, and getting better at it. And so we felt early on that, there was a urban strategy that really worked, that people were looking for places to live that were interesting, that were in walking distance, that had that dynamism of the city, but that had sort of private places where you could kind of go and decompress when you couldn't want to be there. So I think that was a good strategy for us. We were there early, and it has served us well. And then just from a personal perspective, we get this all the time, is development is it's perseverance, it's rolling with the punches, it's reacting to unusual circumstances, being quick to react to opportunities, sort of seeing those. And so it's really like it is to me kind of like the premier kind of entrepreneurial environment. Even the biggest firms in real estate have entrepreneurial characteristics where they are opportunistic, where there are very few layers between the top and the bottom, and where your gut instincts and your moxie are the keys to success.
Interesting. Very interesting. So how can our listeners learn more about you and your business, Adrian?
Okay, well, go to our website, www.neighborhooddevelopment.com. Neighborhood development, all one word. And there are links there to our various social media platforms, LinkedIn, Instagram, etc.
Awesome. Well, great. I will put those links into the show notes. Thank you so much for coming on today, and looking forward to connecting with you in the near future.
Okay, my pleasure, Charles.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.